Hey everybody, Tim Albrick here, and thank you for listening to the YFP podcast, where each week we strive to inspire and encourage you on your path towards achieving financial freedom. This week I had a chance to welcome back onto the show Tony Umholtz, a mortgage manager for First Horizon, formerly Iberia Bank. During the interview, Tony and I talked through how to determine how much home you can afford, a timely topic considering the seller's market we're in and the rising interest rates that are driving up the cost of owning a home. During the show, we talk about the current state of the market, interest rates, and trends Tony has seen through his experiences working with pharmacists across the country. We discuss what formulas lenders use to determine the amount of home they will allow one to purchase, why you and not the bank should establish the budget for buying a home, and we also discuss the total costs of owning a home and things to consider beyond the purchase price. Before we hear from today's sponsor and then jump into the show, I recognize that many listeners may not be aware of what the team at YFP Planning does in working one-on-one with more than 240 households in 40 plus states. YFP Planning offers fee-only high-touch financial planning that is customized for the pharmacy professional. If you're interested in learning more about how working one-on-one with a certified financial planner may help you achieve your financial goals, you can book a free discovery call at yfpplanning.com. Whether or not YFP Planning's financial planning services are a good fit for you, know that we appreciate your support of this podcast and our mission to help pharmacists achieve financial freedom. Okay, let's hear from today's sponsor, and then we'll jump into my interview with Tony. Does saving 20% for a down payment on a home feel like an uphill battle? It's no secret that pharmacists have a lot of competing financial priorities, including high student loan debt, meaning that saving 20% for a down payment on a home may take years. We've been on the hunt for a solution for pharmacists that are ready to purchase a home with a lower down payment and are happy to have found that option with First Horizon, previously Iberia Bank / First Horizon. First Horizon offers a professional home loan option, aka a doctor or pharmacist home loan, that requires a 3% down payment for a single family home or townhome, has no PMI, and offers a 30-year fixed rate mortgage on home loans up to $647,200. The pharmacist home loan is available in all states except Alaska and Hawaii and can be used to purchase condos as well. However, rates may be higher and a condo review has to be completed. To check out the requirements for First Horizon's pharmacist home loan and to start the pre-approval process, visit yourfinancialpharmacist.com/home loan. Again, that's yourfinancialpharmacist.com/home loan. Tony, welcome back to the show.
Tim, good to be here with you.
So we had you last on this show on episode 245 when we talked about getting under contract in a competitive home market. Interest rates at that time were starting to creep a little bit back in March, but they have certainly jumped significantly since then. So with interest rates on the rise, Tony, are things slowing down at all in this market?
You know, it's interesting, Tim. The purchase market has not slowed down. It's still very, very healthy. Refinances have. We've definitely seen a pullback in refinances. There's some cash out refinances where people are taking advantage of their equity position. And then something called a delayed cash out, because seems like there's a lot of people that have money to pay cash for houses. So they're actually coming back to do what's called a delayed cash out. So we've been seeing some of those, but on average, the refinances are way, way down, as you can imagine, with rates coming up.
Yeah, it wasn't too long ago. You and I were talking about refinancing back at the beginning of the pandemic when, rates were in the high 2s, the lowest 3. Obviously, we're at a very, very different point in place. But at the end of the day, we still have a supply issue. So, we see rent prices that are skyrocketing, which I suspect is furthering individuals to want to get into a home, supply and demand. So it feels like despite the rate hikes that are happening, recently, it feels like that for the home buyer, unfortunately, they're still going to be in a very competitive market that is a seller's market. Is that what you're seeing as well?
Yeah, absolutely, Tim. I mean, every market's different, as we've discussed, but on average, most markets are just they don't have enough inventory. And I think clearly that's going to push prices higher. And if you're renting and you could go pay equivalent of your rent or even less buying a home and you get appreciation, I think that's why we have such demand. So there's been no cease in demand out there that I've seen so far.
Tony, I want to pick your brain for a minute. The day we're recording this, we're expecting news today of the Fed to hike interest rates. I think we're expecting 50 basis points, 0.5%, but, awaiting that news. And so is the stock market to see what happens. But I always appreciate your perspective economically on what these types of Fed rate hikes mean and the impact that they may have on mortgage rates. So as you're expecting this news to come out today, whether it's 50 basis points or it ends up being something a little bit different than that, what are the potential implications that we should be looking for?
Great question. I mean, the timing is a couple hours here. We're going to get the announcement. But the biggest thing is that the rates have run up so much this year since January without the Fed doing much of anything yet, right? It's just been talk. It's been kind of projections. And they did raise a quarter, already on the Fed funds rate. And right now, the outlook is 50 basis points today. It could, again, it could be 75. That might shock the market, but let's say it's 50. Really, that's not what I'm pinpointing as the issue for mortgage rates. It's not going to be the front end of the curve. So that front end of the curve, what we call the Fed funds rate, is going to affect your credit card rates, your home equity line rates, maybe some auto loans, floating rates that are floating rates on the market. But long-term mortgage rates are more going to be influenced by what the Fed says about balance sheet reduction. So basically, during the last couple of years, during the pandemic, they were helping stimulate the economy by basically buying bonds, being the biggest buyer of bonds, mortgage bonds and treasury bonds, and that helped push rates lower. So essentially, that runoff of their balance sheet adds supply to the bond market. So that affects rates. And it's going to affect the stock market too, I would think. But that's going to be what I'm watching the most for rates, long-term rates, and how to advise my clients. I mean, I've been in a complete locking bias since the beginning of the year. I've had very few clients that wanted to float, but my opinion's always been lock as soon as you can. And I think today's going to be, we'll learn more about the outlook here and what the Fed's going to do. You never want to fight the Fed in what you do. And the one thing I would say too is inflation is the thing we have to watch for rates as well. If we get any sort of ease in inflation, that could spark a new trend of rates maybe easing a little bit, maybe capping. So those are the things I'm going to be looking for today, Tim.
Yeah. And as you and I talked, before we hit record, if we do find ourselves in a mild type of recession or recessionary period, we would expect, the rates to come back down, which could have implications as well. So certainly we're in a volatile, time period. And to your comment, in case folks aren't familiar with that terminology in terms of rate locking versus floating, in time periods where we may be expecting a reduction in rates, perhaps something like a float matters. But, to your point, this year, as we've been expecting rates to go up, locking as soon as possible typically seems to be in someone's advantage as they're looking at purchasing a home. And so today, what we're talking about is how to determine how much one can afford when it comes to home buying. And I think this is a really timely topic as we've, painted a picture so far. We're in a seller's market. We've got rising interest rates, which of course means more to the home buyer. And we also see that there's more that's out there in terms of the average loan size. So perhaps someone, depending on the part of the country they were living in, maybe a couple of years ago, they were looking at a home that was selling at $400,000, and easily that may be north of $500,000. Obviously, very different depending on the market. And so escalating home prices, rising interest rates means affordability of home is certainly a timely topic. And as we're often talking about, we need to be considering how this home purchase and how the cost of the home fits in with the rest of the financial plan and the goals that someone is trying to achieve. So, Tony, let's start with how the bank determines how much they're willing to lend to an individual. So does the 28-36 rule still apply? And first, if you could define what that is and talk to us about, how that is determined in terms of what one is willing to lend from the institution side.
Sure. Yeah, sure. And so the 28-36 rule has been around a long time. It's a little different nowadays. We look at a multitude of factors, and but just to kind of go back to define what that is, basically the 28% is the amount of your monthly income that can be for a housing payment. Okay. So basically we'll try to make it as simple as we can. So let's say you had a $10,000 a month gross income. The definition would be, okay, so $2,800 can be allocated to a housing expense. Okay. Now, that is not how it's underwritten today, but historically that was something that we looked at. It's still looked at to some degree, but we look at it a little bit differently now. It's more your total debt, right? Your total debt ratio. And that's what the 36% looked at. So they'd say, well, if you make $10,000 a month gross income, we could allocate $3,600 a month to debts. So that might be your housing expense, your car loan, credit cards. One thing that banks do not look at is like your auto insurance, cell phone bills. We typically don't look at any of that in your expenses. It's just creditor debt. So credit cards, student loans, things like that. So, historically that was a metric, especially when we did FHA loans years ago. But nowadays it's more viewed on the total debt ratio. So we typically like to stay at 43% of your total debt or better. And that can be like if you have no debt and you have a $10,000 a month gross income, household income, and you are buying a home that requires a $4,300 a month payment. So that's your total payment. That's your principal, interest, taxes, and insurance. You could still qualify because you have no other debts, right? So that's going to be a fairly large house, but you could still qualify given those metrics. So that's kind of the significance of it. So these are called debt to income ratios is what the terminology is. And that's a very important metric for lenders. In fact, it's one of the most important metrics. Like credit score obviously is important. Reserves can be in certain products, but the most important is the ability to repay. Banks are required by law to prove that. And that's why income, if anyone's gotten a loan anytime in the recent future, or at least in the last 10 years, in the recent past, is you had to give a lot of documentation to the lender because we have to document the income because we have to prove you have the ability to repay. It's called the ATR rule. So that's the reason for these ratios. Just because the bank says you can afford this doesn't mean it's right for you. So everybody's different. Everyone's situation is different. So it doesn't mean it's right for you. Now, the other side of it too, and I'll mention this, is depending on the product, depending on the individual, we can go up to higher debt to income ratios above 43. And that's generally when you're putting 20% down and you have a compensating factor. So we do see that as well. That does occur as well. So I know it's kind of a broad scope, but I wanted to kind of include because everyone's situation is different. It's not like a one size fits all.
Yeah, and that's great, Tony, because I think for many pharmacists, even the numbers you use, so $10,000 a month of gross income, pharmacists, you multiply that by 12, $120,000 a year, pretty close to what we see in terms of national average. And obviously people can do the math if there's more than one income, but I think that's a good point of reference. And just to reiterate what you said, you're talking there about when we refer to percentages that can be allocated to housing expenses, we're referring to principal, interest, taxes, and insurance, which is important. So as folks are looking, on Zillow or Redfin or Realtor, we're looking at homes that they're looking at all those expenses that would be combined. I want to come back, Tony, and just dig a little bit deeper. You mentioned a few things, if I heard you correctly, that will factor into this decision, whether it's a number lower than 43% or perhaps higher than 43%. You mentioned down payment and the amount that's down. You mentioned reserves. I heard you mention credit score as well. So talk to us more about, in addition to just the income that one is making, and obviously they have to produce W-2s or income sources as a part of the lending application. How do those other things factor in? So if I'm someone that's got substantial reserves and I can bring more down, but perhaps I don't have as high of a credit score, like how will that impact, or do some of these weigh more heavily than others?
It does. I mean, there's different types of products out there. So there is different programs we have, different loan sizes, all sorts of things. So everyone's different. So for example, we have loans for lower credit score, people with lower credit scores. I mean, FHA loans, for example, which is a government-backed loan, we can get pretty low credit scores approved for that with just 3.5% down. Now, there is high PMI with those loans, right? There's very high PMI, and then rates can be affected by your credit scores as well. And then we have loans for people that have lots of money and don't show income, which is fairly common with business owners, right? That have sold a business. Or I had a couple of pro athletes I've worked with over the years that, are in between contracts and they've made a lot of money, but they don't have an employer right now. So, and there's programs available for them. So not to get into too much of the granular, but there is different options out there for different people. I would say the key though is the ability to repay. So it's hard to say. Now, for example, the product we offer to pharmacists, we have a minimum credit score of 700. I really can't deviate from that because that's a program guideline. for that particular product. But a conventional loan through Fannie Mae and Freddie Mac I can go down to a 620 credit score with that, which is pretty low, but it's your rates are going to be affected by that. You're may have to put more down than you would like to. And there is going to be a give and take. So it's viewed a little differently depending on the situation.
Yeah. And I think you just highlighted there well why this is not a cookie cutter approach, right? I mean, everyone's credit situation is going to be different. Their income is going to be different. Obviously, the area in which they're buying a home is going to be different. Right. What they're able to bring down, the reserves, the type of loan product they may pursue could be different. So I think really having a good understanding of those and working with a lender that can walk you through those really important, as it needs to be a custom decision to your personal situation. Tony, I want to talk for a moment. You mentioned obviously the idea that yes, what the bank approves is one variable, but also, that may or may not mean that it fits in with the other financial goals. And I think that's really important. You and I have talked about this before on the show, but the bank isn't considering one's list of financial goals in the home buying decision, right? So they may not be thinking about, well, are you on track for retirement? Are you not? How are we addressing, the student loan repayment plan? And so obviously as a part of the broader financial plan, we need to be thinking about that overall monthly budget, that overall housing expense, and how that fits in and allows us or does not allow us to be able to progress and achieve with other financial goals. So again, we're going to have to play by the rules of the bank, of course, but ultimately we need to be setting our own budget. So with that in mind, I want to talk through other costs that folks need to consider. So we mentioned already principal, interest, taxes, and insurance. So those are 4 things that we need to be thinking about. But in this market that we're in right now, one of the things that I want to talk about is just the amount that someone might have to be bringing to the table. And yes, down payment is going to be one part of that. But I know in our area, we're seeing a lot of waiving of appraisal gaps, which could mean that more cash needs to be brought to the table by the buyer. So can you talk to us about what is that in terms of the appraisal gap waiver and why we're seeing that play out in the market that it is, and how that can obviously impact how much money somebody has to bring to the table?
Yeah, absolutely. So let's address that, and we can talk a little bit more about how things may evolve here. But I think the appraisal gap, we're still seeing that in many markets around the country. I mean, there's a lot of high demand markets, and we haven't built enough homes the last 10 to 15 years. So that's why we're in this position that we're in, and builders can't keep up with, because of obviously the tight supply chain. It's taking longer to build and it's harder to build. So the appraisal gap is tricky, because if you agree to this, right, that I'm going to bring this, you basically have to have the cash, right, to fill the gap. So if the price of the home is $400,000 and you have this waiver and it appraises for $350,000, well, the bank's going to use a $350,000, right? $350,000 value. The lender has to use the appraised value. And, let's say we're going to lend you 5% down. It was of $400,000. Now it's 5% down of $350,000. So you're putting 5% down off $350,000 plus the $50,000 gap that you agreed to with the seller. So you really have to plan ahead and look at how much cash you have if you agree to that situation. Now, sometimes it will appraise. You don't know. It may come in okay, but I would definitely, heed your realtor's advice if they think it may not, right? Because there could be a change. One of the things that, we're looking at, every market's different. So you can't speak to every single city in the country, but on average, there's a lot of this happening around the country. But a little bit of a pause would help, right? I think if we could get, instead of seeing double-digit price increases for homes, if we got, mid-single digit would be healthy, right? If you got a 5%, 6% appreciation on your home and you're putting 5% down, you're getting an unbelievable return on your money, and you're not in such a bidding war crisis that we're in now. But I'm hoping that'll kind of happen and will normalize a little bit. But I would just be really careful about what you agree to when you're buying. I'm very cautious about waiving inspections and things like that. I just think if you can get anything plugged in, it just protects you and you have your eyes open. And if you have to agree to something like a waiver, just make sure you have enough time to get your inspections done. So at least the house is in good shape and there's nothing to worry about there. And if there is a little bit of a value change, then, I hate to say it, but the reason you're agreeing to that is there's other buyers out there waiting to buy it too. So there is going to be a lot of demand for real estate for quite some time until you see inventory levels rise.
Yeah, and I think that's the concern, right? Easier said than done. I'm not in the market, for a home in the moment, but especially for first-time home buyers, it's an emotional process, and in a seller's market where we're seeing a lot of bidding wars, I think there's just caution that we need to use when you look at waiving appraisal gaps, waiving of inspections, and some of that as well, because ultimately, again, as we talk about often on the show, home buying is a really important part of the financial plan, but it's one piece of the puzzle, right? And so we've got to make sure that we can enter that home, we can enter that situation with confidence, knowing that we're able to move our other financial goals forward. We were just talking before the show. I mentioned that Tim Baker and I were looking at property here in the area that I think was listed around 530, and it ended up selling for an all cash offer at 650. And that was an example where appraisal was going to come in around that 530 point. So that means in that case that someone's going to be bringing over $100,000 of cash to the table. So that's another thing as we talk about affordability of home. If you find yourself in that position, even if it's a smaller amount, right, $5,000 or $10,000, we got to factor that in on top of the down payment and on top of the other expenses that relate to purchasing that home.
Absolutely. You have to run your numbers on your reserves and how much cash you have if you agree to something to that effect.
Tony, I think it's interesting the trickle down effect of this economically, right? We're seeing rent prices here in Columbus, which I think is happening nationwide, are going through the roof. And obviously that presents a challenge for many folks. The other thing I'm seeing recently, actually I heard an ad this morning. It was a window company here in Columbus that was running an ad basically playing on this saying, hey, instead of moving because we're in the market that we're in, now's a great time to upgrade your home, right? So, I think that we're seeing this rising level of cost. If people are thinking about making upgrades or finishes to their home, windows, remodeled kitchens, basements, whatever. And again, the supply chain issues, it's really hitting people, I think, at all different areas. So certainly a challenging time. And yes, there's appreciation there, but obviously that's offset by some cash flow pinches that can happen in the moment.
Right. Yeah, absolutely.
Tony, I want to go a little bit deeper into, we've talked about principal, interest, taxes, and insurance. So again, as we think about affordability of the home, we talked about the percent down, and that may need to be more because of the market that we're in, especially if we find ourselves in a waiving of an appraisal gap situation. And so the other thing I want to hit on here is that, assuming somebody chooses a fixed loan, and we'll talk about the pharmacist home loan product here in a moment, that principal and interest is going to be fixed over the life of the loan. But one of the things that they need to consider, and I've lived this firsthand, is that taxes and insurance are not fixed, right? So we need to be thinking also about what is variable going into the future. And I don't know markets where taxes are going down. So, our taxes are going up. My homeowner's insurance has gone up over time. And so, hopefully we have income increases that will go up over time, but we're not always seeing that for pharmacists. So we need to be thinking about other expenses that could rise over time. And it's not just in this moment, what's the percentage of my take home pay that am I going to allocate to my home, but how might that go up over time as taxes increase, as insurance increases? And then obviously there's other things to consider, like HOA fees or upkeep or maintenance of the property, all types of things that, again, a home investment is a great thing, but we want to make sure that we're entering into that with financial confidence.
Absolutely. And that is a really good point. So let's say obviously we fix the rate in, we fix the payments in for principal and interest on the note, but there is that variable nature of taxes and insurance. Mm-hmm. And depending on what part of the country you live in, insurance can move quite a bit. If you're in Southern Texas or Florida, taxes or insurance can be a wild card sometimes. But I would say this, I think it's important that you check on insurance maybe every year, right? Whether it's your auto insurance and your homeowners, just see what's out there, because there's new carriers coming to market, and sometimes they'll give you discounts for your policies. And one other thing too that I see, banks, mortgage companies require a certain amount of coverage. That way your house is covered if it were to burn down or, tornado damage or whatever it might be. But one thing I do see, sometimes people overcommit on personal property. So make sure you're insuring what you need. If you have a lot of personal property, clearly you can make sure you have the coverage, but lenders don't care about that. You can put it to zero and that wouldn't be an issue for a lender. So if you're really trying to reduce your costs, that's one way to do it too, is look at like the personal property terms in your insurance policy and your hazard insurance policy.
That's a
So
great call out, Tony. And I would encourage folks, if they haven't done this, in a while, you mentioned kind of looking at this regularly and even just pulling up the policy and looking at the line items, making sure you understand what those things are. And I went through this recently. One of the challenges out there, if you're trying to shop around policies, is getting the apples to apples comparison. So what I found to be helpful was, as I was getting policy quotes, I basically provided the coverage amounts based on my current policy and what the categories were to try to get as close of a comparison as I possibly could. And that's also true on auto insurance as you're looking at, different carriers and options. But great suggestion, a reminder to make sure that we're taking a fresh look at that over time.
yeah, and I think that could help maybe to some degree alleviate some of that movement. But clearly over time, insurance costs are going to go up, especially with inflation. That's affecting insurance premiums because it costs more to replace property, right? So that's going to affect the cost of insurance. Property taxes, with property values going up over time. In some states, they're capped. Some states, they're not, right? So we got to be careful with this too, Tim, because every place is different. But like, for example, in Florida, you have the Homestead Exemption and the Save Our Homes cap, which essentially caps how much your tax basis value can go up every year. And that really helps preserve the tax that you're paying every year. It can only go up a little bit, so it's not a big deal on owner-occupied homes. Now, if it's not owner-occupied second home investment property, it's free lunch, basically. The county can do whatever it needs to do. But every place is a little bit different. Some other states have similar measures, and that can help kind of keep in check how much your taxes go up every year. And generally, taxes are going to rise with the property values increasing. Now, the flip side is, I remember in 08 and 09 when my property values went down, my taxes went down, which was, that was one benefit, I guess, of that time, although I don't want to relive it. But, that was taxes generally go down if the county assesses your property at a lower amount. And the other thing that I find too is many of the municipalities are very, very generous in how they value property, because I'll see some of the tax bills and they're coming in well under the market value in their tax estimator. Yep. It's well under. So it may not be the same everywhere in the country, and every state has different varying degrees of taxes. So I'll just say one thing, like our audience in New York, taxes are really high there, right? And even in Florida, they're pretty high. But, I've seen some other states where they're not bad at all. So just different states can vary on how much those taxes are. So
good call out, Tony, that, it's different everywhere, as well as, obviously there is a situation where they may go down. And I'm coming from the bias of only living in a period. I bought my first home in 2009 and, didn't have a home when that happened. And have been
you bought at a good time.
Yeah, that's right. I've been spoiled by only living in a state of appreciation on the home side. So I want to shift gears and talk about the pharmacist home loan product that you offer through First Horizon. Anytime we do a webinar presentation that includes home buying, Tony, this continues to be the most common question, the number of questions I get in terms of volume around the pharmacist home loan product. And I think it's becoming even more timely. It's always been timely, but more timely because as we see a rise in the purchase price, if folks are thinking, do I need 20% down or something traditional like that, obviously that becomes more of a barrier as the market does what it's doing. So talk to us about the pharmacist home loan product offered by First Horizon. You already mentioned the minimum credit score of 700. Who is this for? Who is it not for? What does it mean in terms of down payment, purchase price of a home? Give us the overview.
So as we discussed, 700 is that minimum credit score. Clearly you have to be a licensed pharmacist. We couldn't give it to just anybody. Some of the attributes of the product is you just don't have to put much down. If you're a first-time home buyer, you're looking at putting 3% down. You're eligible to put 3% down. If you've owned before, you only have to put 5% down. There's no mortgage insurance. So that's a really big driver too and benefit as you have no MI. And I find that with 5% down, the rates are every bit as good as if someone came to me that was not a pharmacist with 20% down. And sometimes better, actually, an eighth better. So you get it sometimes a little bit better rate as well. And the waiver of the PMI is a big thing. There is a loan cap, though, size-wise. We won't go above 647, 200 as far as loan size. I have had a lot of pharmacists come to me with purchase prices of like 680 and they put 5% down and they're fine. They're within the guidelines there. So it still gives you a good bandwidth of price, but sometimes in, more expensive markets like California, it can be tougher sometimes to meet that guideline. We only offer a 30-year fixed on the product. So it's a 30-year fixed only, which I find is popular. And then the other thing that's a nice feature is there's no reserve requirement. So a lot of programs like this require that you have 6 months reserves for loans for specialists, and this one does not have that. And that's a nice thing. No prepayment penalties. So it's a very clean loan. It doesn't have a lot of concerns about it. The other thing too is generally with student loans, it'll use a lower factor than a normal conventional loan will if you don't have a income-based repayment plan in place already.
Okay.
So if we don't know what your payments are, it'll actually use a lower factor than like if we were to go through Fannie Mae or something to that effect, so, or FHA. That's another attribute. I've noticed though, Tim, most of the pharmacists that apply, we've had a lot this year, a lot the last few years, seem to have a payment in place. There's only a few here and there that don't. Yeah. So I find that kind of that income-based repayment is usually the driver, or we just get a letter of what the payments are going to be. And that tends to be the best way to handle things because those payments are generally a fraction of the balance. So
that was my question, Tony. You beat me to it, especially because we're still in this federal administrative forbearance where there's been a freeze on federal loan payments now for over 2 years. That's going to continue through the end of August, if not extended further. So for folks that are listening that I would suspect many are not making payments, is that the case? Then you kind of project out what the payment would be?
Normally, that's the best way if they have a challenge, if it's close qualifying. Otherwise, we use a factor of the balances. That can sometimes cause the debt ratios to get out of line, but sometimes it's fine. So we'll use that factor too sometimes if there's not a payment being made. But normally we just get that letter projecting what the payments will be. And I've found that that's normally what we see. But most people that come to us are already in that position, but not everyone. We do have some that we use the factor on too.
The most common question I get is, hey, tell me more. What is the pharmacist home loan product? Why is it different? Why might it be an advantage? You obviously highlighted the points there. The second most common question I get, which you already addressed, is, hey, that all sounds great, but am I going to pay a higher rate? And you kind of alluded to, of course, for everyone's situation, it's different. But given the minimum credit threshold of 700 and depending on the percent down, certainly it sounds like it can be competitive. In some cases, can be better. The third question I often get is, hey, Tim, I'm a resident, I'm a fellow, I'm a pharmacist, but I'm not yet earning, that full income. And so is this product eligible for me? And I think, correct me if I'm wrong, I think the answer is yes, you're a pharmacist, but you're obviously going to run into some potential issues with the percentages because of that lower income. Is that correct?
Yeah, that's going to be a real challenge to buy at that level. We typically, just because the income level is not where it needs to be, unless you're married and your spouse is earning a good living already in whatever field they might be in, and that can change things. I've had where the spouse is a PA, a physician assistant, or an attorney, and they're having a good income stream while the pharmacist is in training. That can be, so everyone's different to our point, Tim, but yeah, that would be a case where that probably qualifying for a loan. They'd have the ability to do it in that case. But normally I find it's better to kind of wait till you're training and you have that state license and where you're going to be practicing in place.
Tony, knowing that we're at the time of year, so those that are doing residency fellowship that are wrapping up, typically they're ending end of June. So they're in this transitionary phase. And I suspect many might be listening. So for those that are making the transition out where they're going to be going from a resident or fellow income to that full pharmacist income, where obviously things will improve, financially, general rules of thumb in terms of like how many months do we like to see from a lending perspective where they're in that higher income state? So as they evaluate potential timing of a home purchase.
Tim, really month one, we could help them. If they have an agreement and they're getting a W-2 income, month one, we can help them. So they could close in month one. So right out the gate, in July 1st, if that's their first day, they could close. So they'd have the ability to close right away. So this product is not quite as flexible as our doctor product, which will go up. It's crazy. Sometimes they'll go out like over 5 months if you have a contract and stuff like that from your start date. But
Before?
Yeah. But it's a little different program. This one, it'll still allow you to close day one. So they really could get under contract, knowing where they're going to start and be able to close right when they transition in.
Okay. Let me point our listeners to, we've got a page. If you go to yourfinancialpharmacist.com/home-loan, we'll link to that in the show notes. Again, yourfinancialpharmacist.com/home-loan. We have a lot of information, 5 steps to getting a home loan. We go in a lot more detail about what we talked about here today. And then from there, you can get more information in terms of applying for the pharmacist home loan product and getting in touch with Tony as well. So Tony, thank you so much. As always appreciate the conversation and the expertise that you bring to the YFP community. So thank you so much for joining.
Thanks for having me, Tim. Always good hanging out with you here. So enjoyed it. Thank you.
Thanks, Tony. Before we wrap up today's show, I want to again thank this week's sponsor of the Your Financial Pharmacist podcast, First Horizon, previously Iberia Bank /First Horizon. We're glad to have found a solution for pharmacists that are unable to save 20% for a down payment on a home. A lot of pharmacists in the community have taken advantage of First Horizon's Pharmacist Home Loan, which requires a 3% down payment for a single-family home or townhome and has no PMI on a 30-year fixed-rate mortgage. To learn more about the requirements for First Horizon's Pharmacist Home Loan and to get started with the pre-approval process, you can visit yourfinancialpharmacist.com/home loan. Again, that's yourfinancialpharmacist.com/home loan. As we conclude this week's podcast, an important reminder that the content on this show is provided to you for informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on the podcast. Opinions and analyses expressed herein are solely those of Your Financial Pharmacist unless otherwise noted, and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you again for your support of the Your Financial Pharmacist podcast. Have a great rest of your week.